There is a moment, invisible, uncelebrated, completely silent, when everything in your financial life shifts. Not gradually, not obviously, but fundamentally. And here is the part that will disturb you. Most people live their entire lives and never reach it, not because they were not smart enough, not because they did not work hard enough, but because nobody ever told them it existed. Nobody ever drew the line and said, this, right here, this is the exact point where money stops being something you chase and starts being something that chases you. That point has a name. It is called the crossover point. And by the time this video ends, you will understand not just what it is, but precisely when it happens, why most people unknowingly push it further away every single month, and what the math actually looks like when compound growth finally overtakes the speed of your salary. Because yes, there is real math behind this, numbers that will make you look at your bank account differently tonight than you did this morning. But before we get to the math, there is something else you need to understand first, something psychological, something that the financial industry has never had any incentive to explain to you. And it is this: the reason most people never reach the crossover point is not a money problem. It is a perception problem. They are measuring the wrong things, tracking the wrong numbers, celebrating the wrong milestones. And every year they do that, they delay the moment when their money could have started doing the heavy lifting for them. We will get to exactly what that means. But first, let us talk about how we got here, because the story of compounding is not what you think it is. Most people were taught about compound interest the way they were taught about most important things in life, briefly, superficially, and without any real sense of consequence. You sat in a classroom somewhere, a teacher wrote a formula on a board, maybe they mentioned Albert Einstein and some quote about compound interest being the eighth wonder of the world, and then the lesson moved on, and you moved on with it. What they never showed you was what that formula actually looks like in motion, what it feels like when it starts accelerating, what the graph looks like when it shifts from a slow crawl into something almost violent in its upward trajectory. They gave you the concept and skipped the consequence. That was the mistake. Because the consequence, that is where the entire game is hidden. To understand the crossover point, you need to understand something about the nature of exponential growth itself. And the best way to do that is through a story. Not a hypothetical one. A real pattern that has repeated itself across thousands of individual financial journeys in different countries, different income brackets, different life circumstances. The pattern is always the same. Someone starts investing, maybe at 22, maybe at 28, maybe at 35. They put money in every month. Month after month, the number grows slowly, painfully slowly, so slowly, in fact, that they start to wonder if it is even working. In the first year, their portfolio grows by a few $100s from returns. They earned that much in a single day of work. What is the point? This is the moment where most people either stop, reduce their contributions, or simply stop paying attention. And that is the moment they unknowingly step backward from the crossover point. Here is what they did not know, what they could not see because the math had not revealed itself yet. In the early years of compound growth, you are not watching a plant grow. You are watching a seed absorb water underground. Nothing looks like it is happening. The roots are forming. The structure is building. And then, at some point, some specific, calculable point, the plant breaks through the surface. And then it does not just grow. It accelerates. The growth rate of the plant starts doubling on itself. And suddenly, what took 5 years to build in the first phase happens in 6 months in the second phase. That is compounding, not as a concept, as a lived experience, as a mathematical reality. Let us make this concrete, because concrete is where this video earns its place in your life. Imagine 2 people. Call them Daniel and Marcus. Both are 30 years old. Both earn $60,000 a year, $5,000 a month. Daniel saves and invests $400 a month into a diversified index portfolio, averaging 10% annual returns, which is consistent with long-term historical averages of the U.S. stock market. Marcus does the same. Identical setup. The only difference is one decision that each of them makes around year 7. We will come back to that decision. But first, let us follow the math. In year one, Daniel's 400 monthly contributions plus a 10% return generate roughly $5,060 in total portfolio value. His money earned him about $60 from returns that year. $60. He earned more than that in a single hour of work. He looks at this number and feels nothing. This is exactly where the deception lives. The number looks meaningless, but it is not meaningless. It is the foundation. It is the roots forming underground. By year 5, Daniel's portfolio has grown to approximately $30,000. His annual return that year, just from the compounding, is around $3,000. He is now earning the equivalent of roughly $25 an hour from his portfolio, just from it, sitting there, growing. He is still working full-time. His salary is still doing the heavy lifting, but something has shifted, something subtle. The portfolio is starting to breathe on its own. By year 10, Daniel's portfolio is somewhere around $77,000. His annual return from compounding alone is approaching $8,000. That is nearly $700 a month just from returns. He is now earning, passively, what a part-time job might pay. His money is working a part-time shift every single month without him lifting a finger. And the trajectory is about to change sharply. But this is where everything changes. If you have been half watching this video, this is the moment to come back. Because what happens between year 10 and year 20 is not an evolution. It is a transformation. And if you understand it, truly understand it, you will never look at a savings account balanced the same way again. And if this breakdown is making you rethink your own financial strategy, stay with us all the way to the end. What comes next is where the real insight is buried. By year 15, Daniel's portfolio has grown to roughly $150,000. His annual return from compound growth is now approximately $15,000. $15,000 a year, generated purely by compounding. That is $1,250 every single month, appearing in his account without any labor from him. He is earning, passively, a quarter of his salary, just from the math of his portfolio growing on itself. Now pause here, because this is where the crossover point becomes visible on the horizon. It is not here yet, but you can see it coming. The portfolio's annual return has gone from $60 in year 1 to $15,000 in year 15. His salary has not changed at that rate. His active income, the money he trades his time for, has maybe increased by 30 or 40% over 15 years. Typical career trajectory. But his passive return? It has grown by 25,000%. Those two lines, the salary line and the compounding return line, are on a collision course, and the moment they intersect is the crossover point. At the current trajectory, Daniel hits the crossover point somewhere around year 22 to 24. His portfolio by that stage is approximately $350,000 to $400,000. The annual compounding return on that portfolio, at 10%, is $35,000 to $40,000 a year. That is $3,000 or more every single month. That is more than his monthly take-home after taxes. His money is now earning more than he is, not theoretically, mathematically, provably. The passive income line has crossed above the active income line. The crossover point has been reached. This is the moment everything changes, because from this point forward, compound growth does not just match his labor, it starts lapping it. Every year after the crossover point, the gap between what his portfolio earns and what his salary earns widens dramatically. In year 25, his portfolio might be generating $50,000 from returns, while his salary generates $60,000. In year 28, those numbers might flip entirely. His portfolio earns more. He works because he wants to, not because he has to. That distinction is the entire point of wealth building, and the crossover point is the mathematical gate between those two worlds. Now remember, Marcus, the identical setup. Same income, same contributions, same return rate. The only difference was a decision he made in year 7. At year 7, Marcus went through a tough period. A car broke down, a relationship ended. He had some medical bills. He looked at his portfolio, which was sitting at around $38,000, and he reduced his monthly contributions from $400 down to $100. He told himself it was temporary. He would increase them again next year. He did not. He kept them at 100 for 4 years. Then he bumped back up to 300 and stayed there. That one period, 4 years of reduced contributions in years 7 through 11, pushed Marcus's crossover point back by nearly 9 years. 9 years. He reaches the same milestone at age 61 that Daniel reached at age 52. The math is ruthless. It does not care about your circumstances. It does not offer extensions. Every month you undercontribute during the compounding phase is not just a missed deposit. It is a missed multiplication. Because in compound growth, you are not just losing the contribution. You are losing every future return that contribution would have generated on top of itself, on top of itself, on top of itself. The cost of those 4 reduced years was not $1,200 a year in missed contributions. The cost in future portfolio value was over $300,000. Read that again. $1,200 a year in reduced contributions cost Marcus over $300,000 in future wealth. That is the brutal, magnificent, terrifying nature of exponential math. It punishes hesitation. It rewards consistency with a ferocity that linear thinking simply cannot grasp. And this is where the psychology enters the conversation. Because here is the uncomfortable truth about why most people behave exactly like Marcus, and it is not because they are irresponsible or short-sighted. It is because the human brain is not wired to feel exponential growth. We feel linear. We think in straight lines. When we look at our portfolio growing by $60 in year 1, our brain processes that as insignificant, because in linear terms, it is. But compounding does not operate in linear terms. It operates in curves. Sharp, accelerating, almost parabolic curves that look flat for years and then suddenly spike upward at an angle that defies intuition. Researchers in behavioral economics have documented this extensively. There is a documented psychological phenomenon, sometimes called exponential growth bias, the tendency of people to underestimate compound growth over long time horizons. In study after study, when people are shown the actual output of compound growth versus a linear extrapolation of that same growth, they are consistently shocked by the difference. Their gut estimate is almost always much lower than the reality. And this bias has real financial consequences. It leads people to underinvest in their early years, precisely the years when early contributions carry the most compounding potential. It leads people to reduce contributions during temporary setbacks without understanding the disproportionate long-term cost. And it leads people to seek faster, riskier returns, because the slow accumulation of compound growth simply does not feel real until it is already happening at scale. The antidote to this bias is not willpower. It is not motivation. It is visualization. It is seeing the actual numbers at each milestone, which is what we have been doing in this video. When you can see that year 5 brings $3,000 in passive returns, that year 10 brings $8,000, that year 15 brings $15,000, the curve becomes real. It becomes something your brain can track and anticipate. And the moment your brain can feel the trajectory, the psychology of the crossover point shifts from abstract aspiration to concrete countdown. Now let us go deeper, because the crossover point is not a fixed destination. It is a variable, and there are specific levers that move it. Understanding those levers is what separates people who reach it at 52 from people who reach it at 43. There are 3 primary levers, and each one has a multiplicative, not additive, effect on your timeline. The first lever is contribution rate. Every additional dollar you add to your monthly contribution in the early years compresses your crossover timeline more than you intuitively expect. If Daniel had contributed not $400 but $600 per month from the start, his crossover point would move from year 22 to year 18, a 4-year compression. That means 4 additional years of living on the other side of the line, 4 years of his portfolio generating more income than his labor. If you think of a single year of financial freedom as worth, conservatively, the equivalent of $200,000 in quality of life, and that is a conservative estimate, then the decision to increase contributions by $200 per month in your early 30s is worth $800,000 in life value. The math is clear. The decision feels small. The outcome is enormous. The second lever is return rate, and this is where people often make a critical mistake in both directions. Some people chase high-risk, high-return investments, trying to compress their timeline dramatically. They jump from index funds to individual stocks, to cryptocurrency, to real estate speculation, searching for the shortcut. The data on this behavior is sobering. The average active retail investor dramatically underperforms the index over any 10-year period, largely due to behavioral mistakes, buying high, selling low, timing errors, excessive trading costs. The consistent 10 to 11% historical return of a diversified U.S. equity index, reinvested and untouched, outperforms the chaotic pursuit of higher returns in the vast majority of individual cases. On the other end, some people are so risk-averse they keep significant capital in savings accounts, earning 2 or 3%. The difference between a 3% and 10% return over 25 years is not marginal. On a $200,000 portfolio, the difference is approximately $900,000 in final value. The return rate lever is powerful, but it must be pulled carefully, consistently, and with a long horizon in mind. The third lever is time, and it is both the most powerful and the least forgiving. We have established what a decade of head start does. Let us make it even more visceral. If you start investing $400 a month at age 22 versus age 32, the difference in portfolio value at age 62 is not 10 years' worth of contributions multiplied by average returns. The person who started at 22 has a portfolio nearly 3 times the size of the person who started at 32, despite contributing from the same monthly amount. 3 times, because the first decade of contributions had 40 years of compounding rather than 30. Each of those early years is not just more time, it is more time for every previous year's returns to compound further. The multiplier stacks on the multiplier. This is why the crossover point is so ruthlessly tied to age of initiation. The person who starts at 22 and invests consistently hits the crossover point in their mid to late 40s. The person who starts at 32 hits it in their late 50s. The person who starts at 40, if they make it at all within a traditional working life, barely grazes it before retirement. And the person who waits until 45 to start thinking seriously about compound investing will very likely spend their retirement years on the wrong side of that line, working for money that never quite flips to money working for them. But here is what nobody discusses in these conversations. The crossover point is not just a financial milestone, it is a psychological one. The moment your money starts generating more than your salary, even if the difference is small at first, something changes in how you make decisions. The evidence of this shift is documented anecdotally across thousands of individual investor accounts and in research around financial independence. People who reach the crossover point report a qualitative shift in how they approach work, risk, relationships, and time. They become less reactive to short-term economic noise. They make career decisions from a position of security rather than desperation. They tolerate temporary income disruptions without panic because they know the portfolio's compounding engine is still running regardless of what happens in their professional life. They stop making financial decisions from fear and start making them from strategy. That shift from fear-based to strategy-based financial decision-making is arguably more valuable than the monetary difference itself, because decisions made from a position of abundance compound just as powerfully as investments do. They attract better opportunities, allow for longer time horizons, and generate a kind of career confidence that translates directly into higher earning potential. The crossover point does not just change your financial life, it changes your entire relationship with risk, and therefore your entire relationship with success. Now let us talk about the trap, because there is one, and it catches even disciplined, intelligent investors who are doing almost everything right. It is called lifestyle inflation, and it is the silent enemy of the crossover point. Here is how it works. As your career progresses and your salary increases, which is the natural trajectory for most people who invest in themselves professionally, there is a powerful gravitational pull to upgrade your lifestyle in proportion. You earn $5,000 a month, you live like you earn $5,000. You earn $8,000 a month, you live like you earn $8,000. This feels natural. It feels like the reward for your effort. And in moderation, it is. But here is the compounding math of lifestyle inflation that most people never calculate. Every additional dollar you redirect into lifestyle spending instead of investment contributions is not just $1 lost. It is $1 worth of compounding, removed from your portfolio for every year between now and the crossover point. If you redirect $300 a month into a nicer apartment at age 35, and your crossover point would otherwise arrive at age 50, that is 15 years of compounding on $300 per month. The actual cost of that lifestyle upgrade, in crossover point delay, is not $300 a month. It is approximately $230,000 in foregone portfolio value, and it pushes your crossover point back by approximately 3 to 4 years. This is not an argument for austerity. This is not a video telling you not to enjoy your life. This is a video telling you to know the real price of every financial decision you make, because most people never see it. They see the cost of the apartment. They do not see the cost of the crossover delay. The most financially sophisticated people, the ones who hit the crossover point years ahead of their peers, have a framework for this. They call it pay yourself first compounding. Every time their income increases, they redirect at least 50% of that increase directly into investment contributions before adjusting their lifestyle to the new income level. If a raise brings in an additional $1,000 per month, $500 of it goes into the portfolio before they ever see it in their spending account. The lifestyle upgrade happens on $500. The compounding engine is fueled by the other $500. This single habit, practiced consistently through the prime earning years, can compress the crossover timeline by 5 to 8 years for a typical middle-class investor. 5 to 8 years on the other side of that line. That is not a small number. That is the difference between reaching the crossover point at 50 and reaching it at 43. 7 additional years of your money working harder than you. 7 additional years of portfolio returns compounding on an already massive base. 7 additional years of strategy-based decision-making instead of fear-based survival. The compounding of that quality of life improvement is incalculable. There is one more dimension to the crossover point that we have not addressed yet, and it is perhaps the most counterintuitive insight in this entire video. Most people assume the crossover point is an endpoint, that once you reach it, the work is done. The portfolio is generating more than your salary, financial independence is achieved, and the story ends. But the crossover point is not an ending. It is an inflection, a point of departure into an entirely different mathematical reality. Because once you cross it, once your portfolio's returns exceed your active income, the compounding does not slow down, it accelerates. The portfolio that generates $40,000 a year in returns at the crossover point is now much larger than it was 5 years ago. That $40,000 reinvested generates another $4,000 in returns in the following year. Those returns compound. The gap between your portfolio's earning power and your salary's earning power begins to widen, and it widens faster every year. Within 5 years of crossing the crossover point, most investors find that their portfolio is generating nearly double their active income from returns alone. Within 10 years, the portfolio's annual return can be 3 to 4 times the original salary. The trajectory past the crossover point is not a plateau. It is a vertical climb. This is why the world's wealthiest individuals, the people who crossed their crossover point decades ago, continue to see their net worth grow at rates that feel absurd to anyone thinking in linear terms. They are not doing extraordinary things. They crossed the line, and then the math of exponential compounding did the rest. The curve that looked flat for so long became nearly vertical, and it stays vertical. Barring catastrophic mismanagement, it does not come back down. You have been told that wealth is built by earning more. You have been told that the key to financial security is a good job, a growing salary, and careful spending. And while none of that is wrong, none of it is the whole truth either. The whole truth is that earning is the beginning, not the destination. The destination is the moment your accumulated capital generates more per year than your labor does. The crossover point. Everything before that moment is preparation. Everything after it is freedom. The question is not whether the crossover point is real. The math is irrefutable. The question is not whether you could reach it. Almost every person watching this video has the capacity to reach it. The question, the only question, is when. And the answer to when is determined by decisions you are making right now, today, this month, this year. Decisions about how much you contribute, how consistently you contribute it, how aggressively you resist the pull of lifestyle inflation, how seriously you take the invisible, underground, silent work that compounding is doing on your behalf right now, even if you cannot feel it yet. The roots are forming, the seed is absorbing the water, and one day, not as far from now as you think, the surface will break, the line will cross, and you will stand on the other side of it, in a different relationship with time, with work, with money, with freedom. And you will think back to this exact moment, this video, this decision, and you will know that this was the day the direction of your financial life changed. The crossover point is not a myth. It is a calculation. And the most important thing you can do after watching this video is not to feel inspired. It is to open a spreadsheet and run your own numbers. Because when you see your personal crossover timeline laid out in black and white, when you see exactly what year your portfolio's returns will equal and then exceed your salary, the abstraction dissolves. The countdown begins, and the psychology shifts from hoping it will happen someday to knowing exactly how many months of consistent action stand between you and the other side of that line. That is the power of the crossover point, not as a concept, as a target, as a date on a calendar, as the most important number in your financial life that almost nobody is tracking, because almost nobody knows it exists. Now you do. If this video shifted something for you, if the math landed differently than you expected, there is more where this came from. Every week on FinTrove, we go deeper into the numbers, the psychology, and the strategy of real wealth building. Subscribe and make sure you do not miss what comes next, because the next video covers something that directly connects to everything we discussed today. And it is one of the most misunderstood concepts in personal finance. You will not want to come into it blind.